In the world of finance, nothing stands still. The S&P 500, a key indicator of the US economy, is a testament to this fact. Over the past 2 years, the ebb and flow of this index has painted a fascinating picture. On average, stocks within the index have experienced a slight dip with a modest decline of 0.54%. Yet amid this overall decrease, there have been both victors and vanquished. The energy and industrial sectors have emerged as the champions, outperforming their counterparts and claiming the top spots. On the flip side, companies like VF Corp and Match Group have found themselves on the losing end, trailing behind the pack. Despite these ups and downs and the constant shifts in the market, the S&P 500 has held its ground. In the grand scheme of things, the S&P 500 remains close to its record high from 2 years ago, a remarkable feat in the face of economic uncertainties. The world of finance is often dominated by the big players, and this year, 5 megacap stocks have stolen the show. Imagine a club so exclusive, its membership is defined by a valuation of $1 trillion. This elite group, known as the $1 trillion Club, includes renowned tech giants like Apple, Nvidia, Alphabet, Microsoft, and Amazon. Each of these companies has performed exceedingly well, outpacing the S&P 500 by an impressive 30 percentage points this year. Now let's take a closer look at these powerhouses. Nvidia, a name synonymous with cutting-edge technology, reached a $1 trillion valuation for the first time. A key driver behind this monumental achievement is Nvidia's exposure to artificial intelligence. The company's involvement in AI has not only boosted its own stock but also ignited an investment frenzy within the sector. Among the beneficiaries of this AI investment boom is Alphabet. Known for its innovative approach and pioneering technologies, Alphabet has seen its stock rise, further solidifying its position in the $1 trillion club. But what does all this mean for the broader market? Well, despite the market appearing top-heavy, history has shown us that the broader market tends to hold up well, even after winning streaks by mega-cap stocks. In fact, the S&P 500 has consistently experienced gains in the 6- and 12-month periods following such streaks. So, while these tech giants dominate the financial landscape, their success isn't necessarily at the expense of the broader market. Instead, they are setting the pace, shaping the direction of the market, and creating opportunities for other players to follow. These tech giants are not just surviving, they are thriving, shaping the direction of the market and setting the pace for others. While the tech giants dominate the headlines, the broader market tells another story. A tale that expands beyond the realm of big tech, encapsulating the dynamics of the entire market. The concerns about the market being top-heavy with a few tech giants leading the charge are not unfounded, yet history seems to be on the side of the optimists. Let's take a step back and look at the historical data. It shows that the broader market has managed to hold its ground rather well after previous winning streaks of these mega-cap stocks. Whether it's 6 months or a full year after these winning streaks, the S&P 500 has consistently experienced gains. This is an indication of the market's resilience, its ability to absorb the impact of a few high performers and still manage to grow. But what about market breadth? This concept, which refers to the number of stocks advancing relative to those declining, is often used as a measure of market health. And yes, it's true that the market breadth has been narrowing, with a select few stocks driving most of the gains. However, this doesn't necessarily signal an impending downturn for the S&P 500. Historical records show that even during periods of narrowing market breadth, the S&P 500 has managed to secure positive annualized price returns. The only exception to this trend was during the period from 2001 to 2003. This brings us to an important realization. The power of the market extends beyond the big tech companies. The market is a complex ecosystem with countless factors at play. It's not just about the Apples, the Amazons, or the Microsofts. It's also about the smaller players, the underdogs, the new entrants, the disruptors. History has shown us that a narrow market breadth does not necessarily spell doom for the S&P 500. The market is more resilient than it might appear. The market beyond big tech is vibrant, diverse, and full of potential. And that, dear listeners, is a story worth telling. In the ever-evolving world of finance, understanding the past is key to anticipating the future. As we wrap up, let's recap the major points we've covered. Over the past 2 years, the S&P 500 has remained near its record high. with a negligible average stock decline of 0.54%. The reign of mega-cap stocks, such as Apple, Nvidia, Alphabet, Microsoft, and Amazon, has been undeniable. These tech giants have outperformed the S&P 500 by 30 percentage points this year alone, a testament to their ongoing dominance. However, the market's resilience goes beyond the realm of big tech. Historical data reveals that the broader market has remained robust even after the winning streaks of these mega-cap stocks, with the S&P 500 posting gains in the subsequent 6 and 12-month periods. As you navigate the financial landscape, remember these insights. Keep an eye on the significant players, but don't overlook the potential in the wider market. Stay informed, stay ahead, and remember to subscribe for more insights into the world of finance.